Good morning, everyone, and welcome. My name is Manjinder. Today, I'm going to present a presentation on two topics. The first one is a principle-based, various rule-based accounting standard, the influence of standard precision, and audit committee strength on financial report decisions. This case is related with Agoglia CP Daupnik and the Sakumi GT 2011. The second topic is related with the effect of audit committee characteristics and compliance with IFRS for related party disclosure evidence from South Africa. This case is related with Manif Salami Y and Barogi Fundari in 2017. So there are some reasons that why we choose this article, because they focus on implication of the audit committee on financial report under IFRS. It means that its study are attentive to application under the standards, which is applied globally. And one more thing, they use a different kind of research method used in their article. So Agoglia Daupnik and the Sakumis 2011 undertook the quantitative analysis majorly. The second, Manif Salami and Barogi Fernandi 2017, focus on the data which is tracked from financial report from 120 companies, providing a deep understanding regarding the related party disclosure, IFRS.
So today I'm going to take the purpose and research questions of studies. So on the first report, it's the hypothesis stated that the financial statement preparers are applying a less precise financial reporting standard to be likely to be making an aggressive financial reporting decision. Another hypothesis is the difference in the financial reporting judgment made in the presence of a strong audit committee versus a weak audit committee will be greater when the financial reporting standard is more precise than when it is less precise. And the next topic, the purpose stated in the examination of side effect of audit committee characteristics, so which include independence, the number of meeting, expertise, size. So on compliance with international financial reporting standards in the South African context. The second point is it stated the audit committee size is negatively associated with the compliance of IAS 24. And the next one is another hypothesis quoted. The audit committee's independence is positively associated with the compliance of IAS 24. Furthermore, it was analyzed the study that the number of audit committee meetings is positively associated with the compliance of IAS 24. So, the next is about the similarities and the differences. So I'm going to explain the similarities here. The first similarity which is observed in both the article is that they are focused on the impact which is created by the audit committee on a financial reporting in the companies. For the transparency of authorization of results, both the researchers are focused on compliance of IAS 24, which is a relatively good party and the disclosure. This application ensures the legality in the finding. Furthermore, it has also been identified that both the studies are majorly focused on the designer hypothesis. So it means that their articles have a clear point of view regarding the issues which is going to be discussed in the report. For instance, both the reports have a clear goal to provide beneficial understanding regarding the influence of audit committee so that the stakeholders can get benefit from it. Thank you.
Hi, I'm gonna talk about the purpose of this article. Agoglia stated the financial statement prepares applying a less precise financial reporting standard will be less likely to make an aggressive financial reporting decision. Neve stated the examination of the effect of audit committee characteristics on compliance with international financial reporting standards in the South African context. First hypothesis stated the audit committee size is negatively associated with compliance with IAS 24, and another hypothesis created the audit committee's independence is positively associated with compliance with IAS 24. And the similarity in this article, the first similarity which is observed in both articles is that they are focused on the impact which is created by the audit committee on the financial reporting in the companies. For the transparency, and authorization of results. Both of the researchers are focused on the compliance of IS-24, which is related to the party disclosure. This application ensures the legality of the fundings. And it's also been identified that both of the studies are majorly focused on the designer hypothesis. It means that articles have a clear point of view regarding the issues, which are going to be discussed in the report. Thank you.
Okay, now I will talk about the major implications of the findings. It mainly basically depends on the three parts. The first is about accountants in Australian companies. According to the articles, it is mainly around the way in which the management of the company is fundamental for accounting in accordance with the International Financial Report Standards. The first ramifications which can be obtained from the research are that Australian accounting Standard Board 124, which is identified with the evidence of the weakness of the audit comment, must be connected in the reporting. Another implication which can be explained by the auditor examination, namely that the monetary variables and there are specifically determined among themselves. In addition, there are another implications which have been recognized in the proof that accounting holders are also responsible for the direct disclosure of the weakness, whereas amounts reimbursed to executive can be reduced as a result. Secondly, it's about accounting regulators. It is forced expert management accounting monitors, which is responsible for defining the principles to achieve the legitimacy of the accountants, and could be considered finance explanatory related to advertising. Additionally, they also have the second implications in this part, which we are examined in the review, focused on the close research and development in associations. Finally, the last part of these implications are mainly about the external users of the financial reports. The research of the Agogia in 2011 recognized the importance of the corporate governance in accounting, which also encouraged these partners to focus on this area in annual reports. Additionally, the article further examined that Australian Accounting Standard Board 124 was used to record the scale of the vulnerability of the general authority. In this way, financial professionals can be confident about the quality and awareness of the result. It was also stated in the article that the compliance with the IAS-24 can be helpful in the maintaining positive relationship with the stakeholders, so that trust can be ensured and finance can be increased. Thank you.